Well, thank you for joining today. Welcome to today's R&D webinar. We're excited to have you with us as we explore insights into the R&D credit landscape and how it could benefit your company. Before we kick off, I'd like to provide a brief reminder. To receive credit for this course, it's important that you actively engage by participating in at least 75% of the 4 polling questions throughout. If you have any questions at any point, please feel free to use the Q&A box located below. Additionally, for your convenience, we are recording this webinar. Now, for those of you who may be unfamiliar with Sensiba, we are a leading accounting firm ranked in the top 100. Our services encompass tax, audit, and various consulting services, including technology and sustainability solutions. In addition, we take pride in being a certified B Corp and have been serving our clients for over 40 years. Now, to kick us off, I'd like to pass this off to our Director of R&D Tax Credit Services, Colmar.
Thanks, Louie, and I appreciate everybody showing up here today to talk about some changes in the R&D credit landscape and what we need to do to prepare for those. So also presenting with me is Ariane Woods. She's also controlling the slides. So she's going to get into some of the key topics as well, and we'll hand it back and forth. So the things we want to cover today are a basic rundown of the R&D tax credit, right? A lot of you probably have some familiarity, hopefully. We want to go through that and make sure there's an understanding, because it helps to allow you to understand the changes in the 6765 disclosures that are expected to be needed for 2024. And when we say 6765, right, we're talking about the form, the federal tax credit, the federal form that's filed with the tax return to claim the R&D credit. So the form number hasn't changed, but a lot of the content and things that will be expected to be provided on that are expected to change, and the IRS has provided a draft of what they're planning on that front. And then at this point, we're still in an environment where no conversation about the R&D tax credit would be complete unless we covered the somewhat unrelated, though inextricably linked, topic of the required Section 174 capitalization that went into effect for 2022. Many of you have already dealt with, but we'll go into that as well to make sure that we're all on the same page with that topic. So we're going to start out with a polling question. So Louis is going to launch that, and we're going to provide a minute, I think literally a minute, to answer that.
So part of this is we will skip a bit of this. Next few slides, we'll go over a little quicker and focus on some of the other sections. If a lot of the people here have a good understanding of the R&D credit, so that we're using your time wisely.
I'll give it 30 more seconds.
Get you the information you need to try to make some decisions, because we'll go into this in further detail, but the expected changes for the tax form and the disclosure requirements change for tax year 2024, which, you know, we just got done with the 2022 filing season, so that seems like a long way away. But when you look at the calendar here, we're coming up in 2 months on 2024 in reality, and being ready for maybe some additional effort in categorizing R&D expenditures for the R&D credit is relevant.
Okay. Well, and it looks like over almost 2/3 of people are somewhat familiar with the R&D credit. We've got about a quarter who are very familiar, and a little bit of the people here joining us are not familiar at all. So a decently knowledgeable group today.
Okay, so we'll go through these next slides pretty quickly, but I just want to cover the federal R&D tax credit. How much can it mean for your business, right? So depending on the stage of your business, the calculation methods which are used, which we'll get into here in a few minutes, can amount to 5 or 10% of your qualified qualified research expenditures back as a tax credit to your company. So an additional benefit is that it can also potentially reduce your tax below A&T. It's one of the few things that can potentially do that in the case that you're hit with NOL restrictions on carry forwards that started in 2021 and continue for some period in the future. And also, nice thing about the R&D tax credit is any unused credits can be carried forward at this point indefinitely. There's no carry back anymore. There used to be, and you might remember that there was for a long time. But starting in 2022, I believe, there's an infinite carry forward, but no carry back. And then we're going to focus largely on the federal credit, right? But many states have an R&D tax credit as well. And they usually piggyback, and in almost all cases, piggyback on the definitions that are required for the federal credit, which Ariana is going to cover here in a few minutes, with various differences in the way that things are calculated. And one of the big differences being, right, that the expenditures would need to be in the state jurisdiction, just like for the federal R&D tax credit, those expenditures would need to be in the United States or a territory. So a newer mechanism for using the R&D tax credit is the payroll tax offset, which is available for startups. So qualified small businesses in 2022 and prior to that for a few years could allocate $250,000 of federal research tax credit to offset payroll tax. Starting in 2023, that amount was increased to $500,000. So that's a nice benefit there. Getting into the weeds of it a bit, right? The headline number is great, 500,000, and you can definitely generate that much R&D tax credit to offset payroll tax. However, now some portion of it is used to offset the Medicare portion of payroll tax, in addition to the Social Security tax. So the incremental usage of the credit as you go forward does not increase dramatically. I don't want to get bogged down in the details of that. Just want to say the headline number is nice and is definitely worth going after, but it's not going to double the rate at which you could use the credit. So then how do we define a small business and determine whether they're eligible for the payroll tax offset? Well, the basics of it are that in the year that you're electing to use the payroll tax offset, your gross receipts have to be below $5 million. So that's an individual year test in that year. Is it 5 million or not? The other main requirement is that you need to be in the first 5 years of gross receipts. So this is not revenue, and there's no de minimis amount. So if you have $10, if you have $100 of bank interest, right, that flowed onto your tax return in year one of your business when you're operating your business, that would be determined, or that would start the clock as year one for the payroll tax offset. And then you have 5 taxable periods to use to make the payroll tax offset election. So I will also point out the taxable periods part of that, right? If you convert to a short, change your tax year in, have a short year, a short taxable period, that will consume 1 year of your payroll tax offset eligibility.
So I'll take over here and we'll talk. Nope, this is still yours, Cole. Sorry about that. I got the next one.
No problem. Yeah, so I think we need to jump back one slide, Ariane.
I miss? Oh, yep, I did.
Yep. So at a high level, what is eligible for the R&D tax credit? New or improved processes, right? And we want to highlight improved here. People think of their new products. More and more people think of the process development, right? If you're manufacturing something, how do you manufacture that, right? You can develop a prototype, but then it's an entirely different issue and can potentially be an entirely different business component to figure out how to manufacture it at scale with the same quality, etc. So what the IRS wants us to do is define each of those as a business component, right? That's shorthand for project, right? Most of our clients, most of the world would say, what was the project? The IRS says, well, what was the business component? So that's a definitional thing to understand as you're talking about the R&D tax credit. Another key here is that the project, the business component, it just needs to be evolutionary in nature. It doesn't have to be revolutionary to the world. Now, it's wonderful if it is revolutionary, and hopefully it is, right? But it can just be evolutionary to your business. The IRS has not historically been involved in determining, is it important enough to your business? Is it enough of an investment, et cetera, as far as that goes. What they're concerned with is, does it meet the 4-part test? And that's what Ariana is going to get into here in a couple of slides, right? Is getting into, okay, what are the guideposts that allow us to determine if a particular business component would qualify for the R&D tax credit? Because that's the first question. And then how do we attach the expenses and what are those expenses? Then finally, the contract qualification. That adds a layer of complexity in any project, right? If you have government funded contracts, if you're engaging in some sort of research or product development relationship with a third party, right? Whose research is that, and who's taking the risk, and then whose R&D tax credit might those efforts be? So we'll get into that in a minute as well. So as I mentioned, when people talk about how much is the credit, what can I expect back? Unfortunately, it depends, right? So that's because of a couple of things, and it depends largely on the type of calculation that you're using, which is governed by a lot of factors. When the company started research and development, how long the company has been in business, in some cases, what information is available to do that calculation, right? Because just for example, when we're talking about the traditional calculation here, that first sub bullet, if the company was around and performing research and development before 1983, we have to look at a period from 1984 to 1988 to calculate a base percentage, which then allows us to calculate the R&D credit.
And I don't know about you, but that's before a lot of companies were even like able to keep electronic records. And it's also completely outside the statute of required maintenance for most financial documents. The guidance is generally keep things for 7 years and then you can shred it. Well, 84 to 88 is clearly more than 7 years ago. And so even if you might have design records, if you don't have the financial pieces, you can't put together what you need.
Right. So the situation where a company has records from 1984 to 1988 is, increasingly rare, though it does happen from time to time. So at the very least, at the federal level, there's a method where we're able to only look back at the 3 prior years and calculates an increase over that average period. And the place where this really gets tricky for California clients is the California credit. So this alternative simplified calculation I just mentioned that allows us to only look at the 3 prior years is not available for California. So with California, you either calculate a traditional base period, or there's a much less valuable, much less lucrative calculation method that allows you to base it only on current year expenditures. But it is a lot less. Ariane, would you say it's usually 10%, 10 to 15% of what we would see the client generate if they were able to calculate a traditional California credit? So that's something to be on the lookout for if you haven't been claiming it. What periods are we going to have to go back and quantify in order to enable the calculation of this credit at a very technical level?
Okay, now it's my turn. When we start to get into the eligibility for your business component, your project, there are 4 tests for non-software projects. Permitted purpose is the why are you doing this project. Again, as this slide lists, we're looking at bigger, better, faster, stronger. We're making it more efficiently or effectively, that kind of goal. Number 2, it needs to be technological in nature, so relies on a principle of engineering or a hard science. Congress is very clear that this does not include the arts or humanities, and we'll get into that a little bit more in the next slide. Third piece is there needs to be technological uncertainty with regards to capability, methodology, or design. This is not threshold of uncertainty, it's just presence of uncertainty. And so we're looking for something where at the beginning, you don't know how you're going to solve the problem. A lot of companies know, yes, we can do this, but not necessarily exactly how. And that gets into the 4th question. There's a process of experimentation. There are people with the appropriate degrees, background, and or experience who can identify the different ways to solve the problems that are coming up, try things out, iterate as appropriate, and go from where you are to where you want to be. Additionally, you don't have to be successful for the research credit to be eligible for the research credit. One of the jokes in the industry is failure is the ultimate manifestation of uncertainty. Sometimes you try something out and it just doesn't work. And one of the things that's great about the R&D credit is you can still get the credit for that effort. We talked about what is eligible. Let's talk about what is not. The R&D credit, once you've hit commercial production, you're no longer in bounds for this. One of the big questions for a lot of startups is, when are you in commercial production? And so making sure that we are defining that cleanly for the R&D credit is a big piece of what we do. Cole didn't mention it, but we're both actually engineers, and that's part of our skill set, is to help tease out in this engineering process, this design process, where things are. If you are hitting copy paste on something, we don't get to take that time, although a lot of times you're not quite doing that. You're saying, hey, we did this once, let's do it again, but better. And so there is opportunity in that improvement to get a research credit. But if you're just taking a production line and doing it again, you're not eligible for this. The next couple of questions are as you are relating outside the technology space. So these fail the technological in nature. So as you're looking at management functions, another thing we see is competitive analysis falls under this space. The research in the social sciences, art, or humanities hits aesthetics a lot of times. And general business software is clearly outlined. If you're just implementing general business software, like an ERP system, that's not going to count. Foreign research, if your time, and we'll get into what the dollars are here in a minute, but if the person who you're paying, if their feet are not on US soil, that time doesn't count. If you're buying a thing, it's fair game. But if you're buying time and their feet and they're not sitting there working at the embassy, we can't take it. I used to joke with my clients about this. They're like, no, we got to go to our manufacturer to make this happen. And then, as Cole mentioned, funded research. So if someone else is paying for the research, we don't get to include that. And we will get into a little bit more detail here. So if someone else is paying a company to do R&D, there are two big questions that indicate for the research tax credit whose R&D it is. And it's possible to share it, and it's possible to create a space where it's no one's. The first question is, who has the intellectual property? So again, if you have the intellectual property if you are getting to keep this and you don't have to pay a license or royalty to use that at minimum for that client, again, it's considered yours. Doesn't need to be exclusive, so you can share this. But the key here is that you're allowed at minimum to use this again without getting permission or paying for it. Number two, there is a financial risk component, and this can be shared, but you can't duplicate it. So the exclusive rights, both companies can have IP. In the case of the risks, it's 0 to 100%, but that's going to add up to 100 between the parties here. This is separate from the technology risk, but for example, if you're getting paid time and material, you do not have the rights for this. If you aren't getting paid until you're successful, that is at your risk. And so it's possible to create IP with one company, financial risk with the other. Nobody gets an R&D credit. It's also possible to share the IP, have joint risk, and share the credit, share the dollars that go into the credit computation. And so one of the things that we watch for is reading contract terms and making sure that how that slots in. You had a comment, Cole?
Yeah, I just wanted to tie this back to one thing we'll touch on a little bit if we have time at the end with the Section 174 capitalization, right? This contract qualification creates an additional wrinkle when we start looking at it, not just through the R&D tax credit lens, but we start evaluating that for Section 174 capitalization, again, which we'll cover here in a minute. There's a lot of a lot of need for clarity around how these IP rights and these risks might impact an expense relative to the Section 174 capitalization requirement differently and or the same as they're interpreted for the R&D tax credit.
We will touch on software. If you are developing software for commercial sale, and again, this is unlike some of the other pieces for the R&D credit, software is at the outset of the project. If you're intending to sell this, or for example, if you've got some sort of firmware that goes on a product you're selling, these additional guidelines do not apply. If you do, there are an additional 3 parts here. You've got to have, next one, dual use is if you're doing something for that. If you have software that is internal use only, so you're only going to use it inside your company, there are 3 additional tests that are required. So that 4-part test becomes a 7-part test to be eligible for the research credit. Innovative, significant economic risk, and not commercially available, those are defined fairly loosely. And generally, our goal is to say, hey, this is not internal use only software, and make sure that we are only required to manage the 4-part test, because there hasn't been much in the way of legislation around what this includes.
Right. And the big, I think, elephant in the room relative to those 3 additional requirements is the one in the middle, right? Significant economic risk. What does that mean? How is it judged? We don't have any clarity on that to speak of. Is that significant economic risk of loss to the company? How do you quantify that? That makes it a very subjective analysis that is hard to get super comfortable with when you're doing this analysis.
Yeah, $1 million to a startup is very different than $1 million for a Fortune 500.
Well, and there's some sense of judgment associated with that too, right? So we have very big clients who would definitely treat $1 million in a very similar way that a startup would treat $1 million
Yep.
for us. So just a lot of complexity when judging that.
All right, let's talk about the dollars for the research tax credit. The biggest bucket for almost all of our clients is the people that you pay that work for the company. This is taxable compensation, so corresponds to W-2 box 1. It's not just the engineers and scientists or programmers who are working on the projects. It's the people who are supporting that at either as a supervisor or doing testing and other activities that help you go from the design, the idea, to something viable. The second bucket, and depending on the industry, this can be fairly big. Biomedical, the supplies can be humongous. In software, this is regularly close to 0. This is things that you're using in your prototype builds. This is supplies that you're using up as you are testing stuff. Again, biomedical, the testing supplies can be just millions of dollars a year. It's also your development software. We've got a nice picture of a jet engine here, and the CAD programs that do the fluid dynamics can be tens of thousands of dollars a year. Well, as that's a license that is getting used up every year, that is something that can be included for the research credit. The last bucket, and again, this varies quite a bit depending on how the company is structured, is the contract research. So this is when you're buying time, but it's not somebody you're paying internally. So this is somebody on either a 6765 or some sort of PO or other contract. Because those amounts include a lot of overhead, there is a bit of a hit you take. And so you take 65% of that amount gets included in the credit, and that gets included in that 5 to 10% for the federal level. If you are working with a qualified research organization, that can be at 75% instead of 65%. And again, if you're outsourcing testing and certification, so underwriter's laboratory, if you have a technical consultant that comes in and is helping out with your quality work, if you are outsourcing some design or software development, those are all the kinds of things that we would be able to include under these expenses. All right, back to you, Cole, and here's what's coming up for changes.
Yeah, actually, I'm going to throw a curveball at you. Can we go back to slide 15, the wage QRE slide real quick? I just want to highlight before we jump into the 6765 changes, these 3 categories of wages, of wage expense again. Historically, we haven't allocated extremely thoroughly, I'll say, to these 3 categories, right? The industry has been very concerned with understanding the 4-part test and if a project qualifies and the technical time a person is spending, and we might lump it into some catch-all buckets that might include direct conduct and direct supervision and direct support. But these 3 categories starting in 2024 are going to become much more important because this is one thing we'll see in a minute. The IRS is likely going to require us to break out on the tax form itself, right? For each business component, who was the direct conduct, who was the direct supervision, and who was the direct support. Maybe you don't need each component on each business component. Every person won't be fulfilling all the roles, etc. And there hasn't been a change in outlook from the IRS about who could potentially be included, right? So you don't have to be an engineer, you don't have to have any particular formal training, etc., for instance, to be included in direct support or direct conduct. But we're going to need to allocate it to those various categories of potential wage expense. So thanks, Aaron. I just wanted to draw that out a little bit in a
That's
little bit
perfect.
deeper detail, because when we get the screenshot here in a minute, it's a little bit hard to read. We're going to walk through it, but just wanted to draw that out. So we said expected changes for 23 and 24. Technically, they're for tax year 2024, but again, many of these things need to likely be implemented in your 2023 credit as well. And that's because from the IRS standpoint, and what they will say is that this is all information that you have or you should have had if you were claiming the R&D tax credit in the first place. Now, while that is true, I think the reality is slightly different than they would want to make it seem, right? So especially with smaller businesses, the amount of overhead burden that it would take to do the analysis and then additionally put all the paperwork together every single year in all these exact ways, right? Breaking it out by business component, the wage type, supplies by project. One way this has historically been approached with smaller companies is do the analysis, make sure that the relevant detail is there, but then essentially wait until an audit, knowing that we'll be able to ask the questions of an auditor and get the information put together. And that becomes a much more economically efficient endeavor for the client. And I think for the IRS in some ways as well, right? Because what has happened is we work with an auditor to understand what they want to see and especially how they want to see it, right? They're not all the same. They're people. They've had their own experiences in their career and audits and things that they've been through, right?
Sometimes they're really concerned about your project list. Sometimes they're really concerned about how much this person spent doing direct support versus direct conduct. And waiting until the auditor has their specific questions, if they have questions, again, as Cole indicated, is a much more cost efficient for the individual taxpayer way to just manage this.
Right.
But
And
that's changing.
yeah. And one thing that used to happen as well is, right, that we didn't necessarily have to go through that with an auditor for every single business component, right? So even for a small company, maybe there's 20 business components. We would decide, okay, let's take a look at 5 of these, right? Let's go through all these efforts for 5. If we have significant, detail, satisfactory detail, we can all get comfortable with the fact that, we all did our best here and it all looks reasonable. Potentially that changes with what we're looking at here. So this proposed detail, again, 6765, they released the draft for 2024, right? The 2024 tax filing season, September 15th of 2023. The IRS wants to use this additional disclosure, right, to help target their resources to where it can best be used to identify places, within claims, particular clients, particular companies that, have some sort of exposure related to the R&D tax credit. The other thing the IRS has been concerned with historically is that taxpayers are not categorizing business components appropriately, right? And to hear the IRS talk about it right on that last bullet, they're worried that taxpayers are not scaling back their business components appropriately, right? So Ariane talked about duplication. Maybe I'm doing something, but I'm doing it a little bit different, right? Does that make the entire thing, the entire project, the entire process a new business component? Or is there some sub analysis, right? Some sub component, some scale back that should be being done to get at the part of the project that meets the 4-part test? Because when we talk about project, we talk about business component. All of a business component, for instance, might not meet the 4-part test. I guess in which case you would argue then that's not the business component. You need to scale back to the appropriate level of business component for the R&D tax credit. So now this is the drum roll part. Let's start seeing, oh no, it's not the drum roll part. I apologize. Got ahead of myself. This part's still exciting though, so bear with me for a minute. So the timeline of these new disclosure requirements, right? When did we see this coming? The industry basically saw it coming in October of 2021 when the IRS released a Chief Counsel memorandum that essentially changed the requirements for making a claim for a refund. Right? So these are not current year claims. These are going back and saying, oh, we missed the credit for some amount of prior years. We would like a refund for those years. The IRS said, well, we're going to need a lot of disclosure up front, which was largely this business component, the things that we're going to get into. So then last year around December, the IRS began to make it clear that they were wanting to institute these changes. We didn't know whether it would be for 23 or 24. There was some speculation it would be for tax year 23. Now it's looking like it's going to be tax year 24 because in September they released Proc 23-63 and a draft form that we'll get into here in a second. In that, they asked for comments that were due in October. So hopefully they got a lot of good comments.
Yesterday.
Got a lot of good comments. Sorry, we scheduled this a day late. If you're excited to be able to add your comments after our webinar here, unfortunately you're a little bit late, but I suspect that they got a lot of commentary on that, and we'll get into some of the things that they were asking for commentary on. So then moving forward, the reason this is so timely, right, is we need to start thinking about, are there changes we need to make to our process as a company with how we're identifying information? What are the things we can do now as of January 1st, 2024 that might make things a lot easier in 2025 for the 24 filing season, and carried out to the ultimate scenario, it might increase our credit, right? Because if we don't have significant detail on something, whatever that is, maybe it's some set of supplies that we can't track back to the particular business component, we might not be able to include those for the R&D tax credit, right? So we're going to miss some amount of credit potentially. And then obviously this will actually start being filed on returns in March of 2025. All right, so digging into the actual form itself and what the expected changes are. So
This makes more sense if you've seen one of these before, and so we'll go over this kind of quickly, but these are snapshots taken from the proposed form, highlighting again where there's the IRS concerned about things that have not necessarily been done to their preferred level of detail.
Yeah, so some straightforward things here. These are things that don't particularly require any changes to the way any company is doing the R&D tax credit, right? It's just, are you electing 280C? Are you part of a control group? You know, a set extra couple of questions about the payroll tax offset for qualified small businesses, right? So asking for a little bit more info there. So this is really not that big a deal, though it is a change to the form. The next one starts to get into, again, a little greater detail, right? Adding some more things that you haven't had to calculate potentially before. You know, looking at the third sub-bullet there, right? They're asking in a separate section from the section that asks for business component expenses, which will be the next slide. They're asking for officer wages included as qualified research expenditures, right? So that's a clear number that needs to be calculated that was never calculated, I would say in most cases, never calculated before. Basically, and then asking for some other disclosures around, are you relying on the ASC 730 directive? Again, what you'll see on these is an attempt by the IRS to target areas and get information quickly to pose questions to the taxpayer relative to the R&D tax credit.
Yep. And these are basically just, hey, flagging this for review.
And then section F is where it gets really exciting. So this form, we don't expect you to necessarily be able to read it, right? We're trying to convey in a general sense what's going on here, but this is the part where they start asking about additional detail for the company and the business components specifically, right? So 50E through H if you look at the top row and then the second row, those all have drop downs, if you will, in the form. So they're asking, various information. You have to pick, is it A, B, or C? Is it A, B, or C? And beginning to categorize the business component in a way that allows them to identify what they would consider a high risk area, right? So, and then breaking down line 51 through 54 is where they're asking to break out now the direct wages, the direct supervision, the direct support wages on each of the business components, right? So business component A, or one, I should say, I should probably use numbers here. The first business component that we identified up above, well, now we need to allocate the wage expenditures that we're including for that business component in, what is it, 51, 52, 53, and is summarized in 54, right? So this is where we're getting into an additional level of complexity, and that's why we keep calling it disclosure changes, right? The disclosure is different than the things that are being required. Now, again, I'm going to repeat something I already said. The IRS's position is that, well, you needed to already have this information, you needed to already do this analysis in order to calculate the credit in the first place. I think even if that is true, in some cases it is, some cases it isn't. But I think in almost all cases, clients were not spending the effort that is required to put this in a presented format year after year, right? They were just getting ready to be able to present this and know that they did the analysis properly.
Going,
then
thinking.
The same concept applies to the next set of questions, right? 55, 56, 57, just per business component, right? Business component one, what are the supplies that were allocated to that business component? What are the contract research expenditures or rental and lease cost of computers, right? And that actually is it's a funny thing because it used to be an expenditure, and then for a lot of years it wasn't, and now oftentimes it's interpreted to be cloud computing expense that might be associated with the project. The issue one of the many issues we're going to run into with this form is, how do you allocate cloud computing expense, right? At some level, at many companies, you might allocate the expense to a development environment, but you don't allocate.
If you have 7 projects and 15 engineers working on an AWS cloud environment, how do you allocate out your AWS expense across those different things? And so that's one of the big questions we're going to get to wrestle with starting next year.
Yeah, and hopefully the IRS will be providing additional guidance on this, but who knows?
They have promised to, along with instructions. The big thing to note here is the old form was 2 pages, not quite full, and the new form is almost fully 4 full pages. And so it is a significant increase in the level of reporting that you'll have to put together.
Well, and I would say even beyond the page count, right? One thing we're getting to here is the effort, right? So the form previously, right? All the work and all the time it took for the research tax credit was really done outside of the form, right? So those things, interviews and quantifying people's time and the calculation, and then getting it into the tax form itself, in the tax software, the tax teams, right? The tax return teams, somewhat inconsequential as far as the amount of time needed. Now, depending on how this all plays out, just filling out that form, right, is going to be a significant task for someone.
Yeah. So what can people do to prepare, Cole?
Well, we have a lot of ideas. So if you do have time tracking, right, make sure that you have the appropriate level of detail and compliance, right? We have clients who maybe have some time tracking, but they don't have great compliance, so they may as well not have time tracking. So if you don't have great compliance, obviously work to make sure that people are actually putting good information into the system. Now's a good time to, if you have a time tracking system, now's a good time to evaluate and for 2024 and see, are you offering the right level of detail? Is it too much or is it too little? one thing that we often see companies that try to implement time tracking, they try to have too much detail, right? And then people get paralyzed by the amount of choices that they might have for the time tracking. And just to make sure throughout the year, throughout 2024, that they're actually tracking their time to the system and they don't get behind and things are done in a timely manner.
So if you don't have time tracking, again, consider implementing it. And then make sure that it's not just the direct people, but quality manufacturing and production. If you're not going to do time tracking at all, one of the things we do for some of our clients is we do quarterly surveys, and we'll be updating that format to more accurately represent what the IRS is going to look for. Make sure that as you're putting supplies into your data tracking system, that you're somewhere sticking a business component name in there, so that it's a searchable field. If it can be its own field, that's ideal. And the IRS is considering making some of this optional for companies that are small enough, certain types. The real challenge we're seeing is we don't expect good clarity on that prior to when you would have to start collecting this data. They expect you to have it. The question is whether you're going to report it or not. And so our recommendation is generally, please just start doing this now, and you'll be ready no matter when the instructions finally come out telling us how to handle this for them.
Yeah, and I really want to go back to that middle bullet, right? I think that is the biggest thing that we need people to think about at this point for 2024, right? Is including in the memo line, right, of the transaction for the supply. What was the business component? You say, well, we don't know what the business components are. We don't know what they were. Well, for our clients, we're going to try to get ahead of this and work with them to try to identify those. And, we can always reconstruct the business components after the fact and quantify wages, right? We have a system that, can be customized to the client, and we can, customize it to particular business components and make that part relatively easy. The thing that is really hard to reconstruct is this additional detail in the transactions in the general ledger, right? What was the supply? What was the contract research expense? That is going to be very hard to reconstruct, and I think that is the big message right now for 2024 is try to find ways to add some additional detail if it is lacking currently.
Speaking of which, it's time for our next poll. This is basically, how much did we scare you? So are you extremely concerned, somewhat concerned, not concerned, or don't know? We had originally planned to let this run for a sec, but we're starting to run a little tight on time. So we're going to go ahead and dive right into the section 174.
RN wants to make sure we scare you more. Want to have plenty of time to scare you more.
Yes, that is fair.
Please do answer that polling question.
Yep. And as a reminder, we will have two more. They'll just come fairly close together, but we'll get all four of them in.
The next ones are in pretty close succession here, so we'll zip through this because this 174 topic is really a webinar unto itself. I'm not going to try to do it justice necessarily in the next 10 minutes. I just want to get some content in front of people so they know that it's a thing, right? So as of tax years that began after
12/31 of last year,
2021, so 2022, you're required to, instead of expensing research and experimental expenses in the current period, as you've been able to do since the 1950s, you were now required to identify, capitalize, and amortize those expenses. This was a development, this was a change that was made in the TCJA back in 2017. And everybody knew that this was so terrible. This was such a bad thing that was going to happen in 5 years that it would have to go away, right? It was going to make the country so uncompetitive when it came to R&D, it would have to be fixed. Well, it didn't get fixed. So we've been working with clients through the 2022 filing season to figure out, help them quantify a 174 expense. Us ourselves, we're trying to figure out what a 174 expense, because there's just been really no great definition around it, again, since the 1950s. So the amortization period is a bit steep. So US expenses, things have to be capitalized and amortized over 5 years. There was actually an additional surprise in there when we began presenting this to our clients, is even though it says 5 years, you don't quantify the expenses and divide them by 5 and spread it out. It's a mid-year start. So in the first year, you only got 10%. In 2022, you only got 10% of that expense in the current period, and the rest is spread out over the subsequent periods. Foreign research is an even bigger hit. So that is a 15-year amortization period, but again, a mid-year start. So you got, 3.33, is that the right number? Percent of those expenses in 2022, or in the first year you incur them, right? And then the way most of you probably can realize this pretty quickly, the way the amortization works, right, is it stacks year over year, right? So then in 2023, we'll be getting the first year amounts from 2023, the pulled forward amount from 2022, and again, it stacks on itself. Ariane's going to cover in quick detail.
So the keynote here is that nice Sensiba light green, the Section 41 costs are definitionally Section 174 costs. So at minimum, no matter what you do, your starting point for further analysis, it's really helpful if you are doing the research tax credit, because it gives you a good starting point. 174 adds some layers, and we got one more slide after this that'll go over it, but it's got a lot of other stuff that gets baked in. It's the foreign stuff. It's everything for patents, not just some of the parts of patents. If you're doing software development of any kind, there's a single line item. Everything that software gets included is in the legislation. That's not quite verbatim, but it's functionally, if it's software, it's included. Because again, 174 was written in the 1950s, and software was just not a thing at the time. And so the Tax Cuts and Jobs Act just says everything that software is in the pile. We also include a lot of overhead. And as a reminder, while Section 174 is mandatory, Section 41 research tax credit is optional. That ends up meaning is the research credit, whether you take it or not, is up to you, but you're still going to get hit with 174. So the research credit, since you're going to have to compute those anyways, is a way to take out some of the sting of the 174 costs. Our modeling suggests that typically for most companies, by the time they hit year 4 or 5 in the amortization schedule, they're going to kind of be back to at least where they started, even though you're never really going to catch up because it's the timing thing.
Yeah. So just real quick, take this out to its ultimate conclusion, right? What I like to tell clients is eventually the IRS is going to come in and be trying to make the case that a bunch of things are Section 174 costs, but not as much, nothing qualifies for Section 41, right? You've got all these 174 expenses, but they don't meet the 4-part test. They're not Section 41 costs. Now, I also disclaim that, the IRS, they're all people doing the best they can, trying to get through the day. But what this is setting up is a scenario where, big 174 expense, small 41 expense, that's going to be the position that we're battling against in a potential audit. And then, Louis, if on the next slide, we go ahead and launch poll 3, so we give some people some time on that, because we're running into some
and so issues. Again, for 2022 tax filing season, which is wrapped up for the most part, people should have done this. We're just checking in to see, hey, how much of a struggle was this for you? Section 41, a couple of big differences. Section 41, the research tax credit, uses taxable wages. Section 174 is gross compensation. Patent expenses, it's a wider footprint. As I mentioned, if it's software development, it's in the bucket. International gets included for 174. So if you have an international software developer, or let's say you have manufacturing overseas that is doing R&D work on their process, for Section 41 research tax credit, those aren't available to us. For Section 174, they have to be included. There's also a whole list of what's called other costs incidental to R&D. And so this is basically just the cost of having those people and that effort being done in your facility. So it's the burdened cost of these people. So it's your payroll taxes, it's your part of healthcare, not just the employee's part of it that gets wrapped up, the pre-tax portions. If you're helping contribute to 401k, which is something you kind of need to do to be competitive in this market right now, if you have a building, your portion of the building that's allocated to R&D, completely not eligible for the research tax credit under most circumstances, but here we are having to include it for 174. It's generally we've seen a multiplier. So if you take your Section 41 research tax credits, if you have $1 million in research credit expenses, we'll see at least 1.3 million, all the way up to closer to 2 million generally. And if you've got a big offshore footprint, I think the highest multiplier we saw was like 2.25, 2.5. So if you had, again, $1 million of US expenses, we had a rare occasion where we saw 2.5 of international footprint for those.
Yeah, and just figuring out that allocation methodology, right? That's one place where if you're already doing an R&D tax credit study, right, we're gaining valuable information where we can apply a percentage, whether that's a full-time equivalent of qualified wages to overall wages, or some
Square
other
footage
allocation. And essentially that's what the IRS said in their guidance with this when it came out, was it allocated in some way that makes sense, and you'll be on the right side of things. So
all right, there's our poll. Do we have the answers for the poll yet? We got some, definitely about half the people say it was hard. And that's actually going to be once we pull out the I don't knows. So a little over half the people who had to deal with 174 said it was okay. A little bit of easy, and then a good bit more that it was kind of a pain.
the people that said it was easy were definitely our clients. So thank you for that, everyone. So we'll jump through a couple of other slides here, and then we'll get to the fourth polling question. So, 174, talking about specified research and experimental expenditures. The IRS did provide guidance, though many people felt like it was late, right? It was, I think, 6 business days before the September 15th filing deadline. So they had pretty thorough recommendations and guidelines about what they intend to use to govern these 174 calculations and what is required. Another interesting note here is that this is an accounting method change, technically. So they provided a mechanism by which companies who were required to make this change, right, anyone doing R&D, did not actually have to go through a 3115 accounting method change process and receive approval as you normally would. But we don't, as of now, have that latitude for 2023, right? So if your company is doing R&D,
if you didn't already do this, you're going to have to go through the 3115 process.
Most likely. We don't know a lot of things for certain with this, but I would envision that in the future you will need to make that change, unless, of course, you're a startup business and you didn't previously have R&D, then potentially you might be relieved of that obligation, possibly. So on the next slide,
there's actually not a ton to cover here. We
we
mentioned that the Tax Cuts and Jobs Act, and there's been good faith efforts by a number of different Congress people to undo this. None of them have gone anywhere, unfortunately. But there has been effort. I think my last count was close to 10 different tries to undo Section 174, and just can't get any traction because it's expensive. This is a revenue raiser, and it's raising revenue.
Yeah, it's expensive to get rid of, even though everybody wants to get rid of this requirement because it makes us uncompetitive in a lot of ways as a country. So where do we go from here? Well, we have to assume that this is going to be a requirement for 2023. So adding any visibility that might be needed into our records to make sure that we can accurately quantify this at the end of the year, because we just have to plan for it being around. So with that,
let's go ahead and launch the fourth poll, please. And then
feedback about whether you'd like to discuss this in further detail with us. And Ariane's going to keep up our pictures for as short a time as possible. Thank you.
There's Cole's contact information. We have a couple of minutes left. If anyone wants to throw anything in the chat, or sorry, the Q&A, the only ones we saw were about the this being provided for review. So the recording will be provided. If anyone has any questions, please throw them into the chat. Otherwise, we covered a lot of ground today. Hopefully didn't scare anyone too badly. There's definitely more guidance expected for both the upcoming changes to the 6765, the federal form for the research tax credit. And the IRS is also expected to release more guidance on Section 174. I think they were also really hoping Congress would make this not happen, which is why the guidance was so late.
In many ways, they were caught in the middle as well, right? They're a resource-constrained organization. They're not going to spend resources, on a topic that everybody knows is going to go away, but it didn't go away. So we all dealt with it, and we'll continue to deal with it in the future. But yeah, as Ariane says, feel free to reach out if you have questions, you want to talk about your situation specifically. I'm always happy to chat. I'll follow up with a Calendly link. I love Calendly.
There are two questions that just popped in. The date is the date displayed is your tax year. So it's tax year 2022. So if you are a 12/31 year end, it is going to be your 1/1 of 20 or 1/1 of 22 to 12/31. If you're a fiscal year end on 12/31, it's that tax year is the one that matters. For Section 174, yes, pension expenses and payroll taxes are included. It's going to be a share that allocates with the people. So if you have someone that is spending 50 of their time in qualified activities, it would be 50% of their pension expenses and payroll taxes. So that is definitely adds a lot of cost depending on how good the benefits package is. And thank you for the compliment there. We appreciate that. This has been helpful for the attendees. Anything else? Otherwise, we'll give you at least a couple of minutes back. This one was a lot of ground to cover today.
Yeah. Thanks everybody for joining. Hopefully we'll see you on the next one.